Recession is in the air, whether we admit it or not. Signs of an economic slowdowns are around us. What happens during a recession? During a recession, it is typical for stock values to decline and the unemployment rate to increase because investors have less money to invest and less confidence in the market to grow their investment. This decreased demand for stocks, meaning stock prices will naturally go down. Another major effect of recession is lower business income. This causes companies to stop employing or companies just lay off staff. Many enterprises will close, causing employment losses. Unemployment rises as a result. Consumers save more due to high unemployment and economic uncertainty. This spending cuts can lower firm revenues. So this goes on in a cycle. Recession usually lower inflation. If we talk about the good effect of recession, it would be a decrease in inflation rate. Inflation in simple words is a rate of increase in prices, or you can say increase in the cost of living in a country. Inflation is the economic phenomena that cause a currency to lose value, and it can destroy an economy if it gets out of control. So economic slowdowns or recession can lower inflation. Let's talk about some examples of recession. In the recent past, COVID-19 caused the Great Lockdown, and this resulted in a global economic recession. Most countries entered recession in February 2020. After a year of stagnant economic development and consumer activity, the COVID-19 lockdowns and other safeguards taken in early 2020 pushed the global economy into crisis. Within 7 months, every advanced economy was in recession. So how can you predict a recession? Obviously, recessions are not completely predictable. If they were, we would be able to better plan for them or even avoid them. Having said that, there are a few warning signs that can lead economists to predict a recession may be on the horizon. These signs are what economists call leading indicators. There are also lagging indicators that usually are seen when the recession is already taking place. A high unemployment rate is the most prominent lagging indicator. One notable leading indicator is an inverted yield curve. Inverted yield curve, in simple words, you can say is paying more money to have a short-term borrowing than a long-term borrowing. If the yield curve is inverted and the long-term yield is lower, that can signal a lack of faith in the economy and a recession is on the horizon. In the history, an inverted yield curve has signaled every US recession since 1970. Inverted yield curve is a big sign for economists to predict a recession. And this inverted yield curve is recently seen. Another sign of an impending recession is a decline in manufacturing jobs. Less demand for manufactured goods can be a sign of decreased consumer spending. So if factories cut workers or stop hiring new ones, that can mean cuts in other sectors are on the way. Other leading indicators include falling home prices, a contraction in the stock market, and a lack of new small businesses. The important thing to keep in mind during a recession is that things will turn around. The economy will rebound. Consumers will start to spend again, and jobs will come back. This idea may be harder to swallow in the midst of a recession, but it's crucial to keep in mind so you don't make any rash decisions. If, for instance, you sell all your stocks because you are afraid of the prices dropping further, you won't be able to make advantage of the recovery that tends to follow a market downturn. If this video was helpful for you, don't forget to like, subscribe, and share this video. Thanks for watching.